Hello and welcome to this session in which we would look at auditing property, plant, and equipment. In the prior session, we looked at an overview of the cycle and we looked at internal control, how to assess certain internal control over the PP&E cycle. In this session, we're going to dive deeper into the auditing process. The first thing we want to discuss is why auditing property, plant, and equipment is unique. Although it's part of the acquisition and the payment cycle. There are several reasons why that's the case, why property, plant, and equipment is different than inventory, different of receivable. One reason is lower volume of transaction. Unlike inventory, which can happen daily, property, plant, and equipment acquisition are sporadic and often occur in bulk purchases or major projects. So the volume is much lower, so we don't have large volume. Two, the dollar amount is usually high. Individual PP&E purchases such as machinery or factory building, they represent a large capital investment that could significantly impact financial statements. So we have to be very careful when we are auditing property, plant, and equipment. And the third is those transactions influence the financial record. They're on the books with us for many years because we have to depreciate them and adjust them for impairment. Therefore, any error in the initial acquisition will carry for future years. That's why this process is a little bit different than auditing, for example, inventory. So given these factors, auditors prioritize examining current year acquisition, disposal, and depreciation calculation simply over verifying the ending balances. Because what we want to know is, once we put it on the books, once we have the proper amount, that proper amount will not change. Maybe we'll dispose of it, but that amount, once it's correct, it's going to be depreciated, it's going to be subject to impairment, so on and so forth. So that's why we don't worry much about ending balances as long as we know the beginning minus depreciation plus addition minus impairment, we're going to get to the ending balance. So as long as we take care of what's in between, the ending balance should be correct. So what we will do then, we're going to look at some key audit procedures when it comes to property, plant, and equipment. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
We're going to look at few of these key audit procedures. The first one is performing analytical procedures. Now, I'll tell you from personal experience, performing analytical procedures for the PP&E cycle is very beneficial. It's very useful. In other words, you can rely to a great degree on analytical procedures. Verifying current year acquisition, we have to do that. Checking cutoff and ownership, ensuring proper classification, verifying disposal, reviewing depreciation expense and accumulated depreciation, and last and not least, making sure we have the proper disclosures in the notes to support the numbers on the financial statements. Now, what I will do is I will go over each one of these key audit procedures separately, explaining what it is, what does it serve, so on and so forth. We'll spend a little bit more time on analytical procedures, starting with analytical procedures. What can you do? Well, for analytical procedures, you can compare prior period balance and depreciation expense with the current year balance, considering changes and conditions in asset composition. The first thing you can do, look at PP&E last year, look at PP&E this year. And if there was no new acquisition, for example, if PP&E was $100,000 last year and we had no new acquisition, PP&E should be $100,000 this year. Now, depreciation expense and current period depreciation balance might change a little, may not. If we're using the straight line, it also should be the same. So if we're using the straight line over a 5-year period, we will have depreciation expense of 20 last year. We would have depreciation expense of 20 this year. So this procedure involved comparing the balances of PP&E and depreciation expense from the prior to the current period. It helped identify significant fluctuation or inconsistencies that could indicate errors, misstatements, or fraud. And this ensures that recorded asset value and depreciation expense align with past trends and expected changes. So you would look at the big picture. What did I have last year? What do I have this year, given the changes? It helps the auditor detect improper asset capitalization. So if we did not buy any new asset, if there's no record of that, if management told us we did not buy any new asset, why is there a change in the asset cost? Or if they told us they sold certain assets, we should be able to determine that the balance should not be the same because they dispose of certain assets. Or if they computed the depreciation incorrectly this year, we would know this if they're using the straight line method. So looking at these figures from year to year, it will help comparing these balances. So a company had $5 million in PP&E, but this year balance had dropped to 3 with no significant asset disposal. So the question is why? Why would property, plant, and equipment that should be recorded at cost and remain at cost went from 5 to 3 and we had no asset disposal? Something is not right. Okay, and we're not dealing about net book asset. We're looking at gross PP&E. Went from 5 to 3 million. So that's one thing we can look at. So this may indicate an error in recording addition or disposal. There's something wrong. We need to take a look at what's happening. Obviously, it went down. Well, did it go down? Did we dispose of $2 million of assets? What happened? Did we write them down? Is there any impairment? Looking at these records, it will help us, start our audit procedures. Another thing we can do is we can compute ratio of depreciation expense to PP&E. Now, what we do is we look at depreciation expense over PP&E. Now, over the years, that number should be stable. This step compute the depreciation expense as a percentage of the total PP&E and compare it to previous year ratios. This helps the auditor verify depreciation expense is recorded consistently. So as I mentioned in the prior session, if we have on the prior slide, if we have 100,000 in PP&E, we're using the straight line over 5 years, the rate should be 20% because every year 20% of whatever we purchased should be depreciated over 5-year period. If there's any change, a sudden increase or decrease might suggest a change in the depreciation method, error in computation, or missing asset. So all what it does, it tells us something is we need to look into a little bit further. Maybe depreciation is computed incorrectly or the property, plant, and equipment is computed incorrectly. So a company has a historical depreciation to PP&E at 10%, but this year has dropped to 5 without any asset disposal. Well, if we dispose of assets, if it went from, let's assume, 90 to 80,000, though this should change obviously, but we need to be aware of this. This may also indicate that some new assets are not being depreciated properly, or if there's any change, it means we did not add to the property, plant, and equipment, or if we added, we're not depreciating this amount properly. If our rate is around 10%, why did it change? Why was there an increase or a decrease? Another thing we can look at is comparing ratio of repair and maintenance to PP&E. Also, companies over the year, they will have some sort of a repair and maintenance ratio. It doesn't have to be the same, because in some years you could have a high repair and maintenance out of nowhere. So let's assume they have again 100,000 in property, plant, and equipment every year on average, and usually repair and maintenance is 5,000, so it's around 5%. Let's assume suddenly this ratio went up to 8% or to 10%. well, it means this number, the numerator changed. Now it's like 8,000 or 10,000. You need to ask why. You need to ask them, did you have any major breakage in the equipment? That's why you are spending more on repair and maintenance. Again, this could happen. I'm not saying it did not happen, but this 5%, starting with the 5% base, it gives us an idea what's happening. Maybe it was not an additional repair and maintenance. Maybe we bought another asset for 5,000 that it should be added to the property, plant, and equipment. So this procedure involves computing ratio of repair and maintenance to PP&E and comparing this with the prior year, looking for anomalies. Anomalies could happen. For example, I'll tell you one experience I had. Once we were auditing a condominium, a condo, and what happened that year, they had a major breakage in their water system, and they spent around $250,000 on repair. Well, that was a huge increase in the repair and maintenance. That, draws some red flags. Why is the repair and maintenance ratio is much higher than the prior year? Then they explained to us, we looked at the paper, yes, indeed, it was a huge repair expense in that condo building. It was a huge condo building. Now we need to identify whether a company is improperly classifying capital expenditure as repair and expenses. It could be that also that something should be in PP&E. Now it's going to repair and maintenance. So you have to be very careful. Large increase may indicate that expense should have been capitalized rather than expensed. For example, that $250,000, we need to examine whether this is an expense or whether it's a capital asset. If it's a capital asset, it's added to the property, plant, and equipment. If it's a repair expense. So you have to kind of look at this expenditure. So a manufacturing firm has historically spent 5% of its PP&E value on maintenance, but this year the ratio jumped to 15. Further review reveals that $500,000 in major equipment upgrade was incorrectly classified as maintenance and expense instead of capitalizing. So what happened is they spent $500,000 on major upgrade and they treated it as repair. Well, once the auditor saw that the ratio is 15%, is like something is unusual, then what you do is you would inspect list of those repairs. You would look at the general ledger for repairs, and at some point, April 5th, you see this $500,000. Like, wow, this is a huge repair. Could you tell me a little bit more about it? Well, we did an upgrade. Well, this should not be here. This should be in property, plant, and equipment. So just by this 15% triggered further review. Now on the CPA exam, you could see something like this, and I saw it many times on previously released AI CPA questions, simulations to be specific, where they give you the general ledger for the repair, and one of the amount will be large in a sense that it's a little bit large than other expenditure. And you would say, hold on a second, why is this large amount in property, plant, and equipment? And most likely what would happen is it was misclassified. Rather than property, plant, and equipment, it's misclassified as, you guessed it, as repair. So we'll have to take it out. Other analytical procedures, you compute the insurance expense to PP&E. And this is important. And you would compare this ratio to the prior year. This step compute insurance cost. So in the numerator, you'll have the insurance cost. Let's assume 10,000 divided by property, plant, and equipment of 100,000, 10%. So from year to year, this should stay the same. This ensures that insurance expense are recorded correctly and no major assets are insured. Now, what could happen is this. If we have more assets, let's assume now we have $200,000 an asset, this ratio will drop to 5%. You would say, hold on a second. Why did it drop? If you acquire more assets, it means you should insure them. As you acquired more asset, your insurance cost should go up. So it tells you something is not right. It could be that the insurance company told them, don't worry, you bought an additional 100,000 and we're not going to increase your premium. You'll be in good shape. That could be the case. Then you would ask them for the policy, but looking at this ratio would help you start this conversation. So a sudden decrease in insurance expense relative to PP&E may indicate missing policies or underreported assets. So either the assets are underreported or, it should be more than 10,000. The 10,000 is incorrect. Maybe it should be 20,000. 20,000 divided by 200, you're back to 10%. So a logistic company has an insurance policy ratio to PP&E of 3% for several years, but this year it dropped to 1%. The auditor discovered that newly purchased vehicles were not added to the insurance policy, posing a risk to the company. Also, you can tell them, look, you bought those. That usually doesn't happen. You have to have insurance. but they did not add them to the insurance. They did not add them to maybe to the insurance account. Obviously, when you purchase a vehicle, you should have insurance, but maybe they misclassify the expense as some other expense. It's not insurance expense. Therefore, or it could be, they did not buy insurance. This is just CPA exam is la la land. We could assume anything we want to, but the point is something is missing. If they have more assets, they should have more insurance. That's the idea. And that ratio should be the same. And 3% is a reasonable amount. You pay 3% to protect your asset. So every time you buy an asset, the insurance company needs 3% to protect it for you. So this ratio should stay stable. Other thing that we can do is we can review capital budget and compare them with the amount spent with the budget. We could look at the budget. This procedure involves analyzing capital expenditure budget, what they plan to spend, and compare it to actual spending to identify any deviation. It helps the auditor assess whether management is following approved investment plan. This is what they said they will. Let's assume they said they want to spend half a million, and they end up spending 700,000. Well, why would this 200,000 increase coming from? We need to know. So we could identify potential unauthorized spending, because what was authorized is $500,000, or we could authorize budget overrun or underutilization of resources. Any of these could be a possible explanation. A company budgeted $2 million for new machinery but only spent $500,000. Upon investigation, the auditor finds that the company delayed investment due to cash flow issues affecting future capacity. That's fine. Future production capacity. That's fine as well. They budgeted to, they spent $500,000. We just want to make sure that they did not bought anything. It was not recorded. You want to make sure they only spent $500,000. There's, huge difference between what they said they were going to spend. But if they have cash flow issues, we would know this from the cash account. So remember, once you figure out a red flag or an area to investigate, well, you could look at other interrelated area to try to explain that. So if they said they did not have cash, we would look at their cash account to determine if they were having some cash flow issues, and that would be easy to determine. So those are some of the analytical procedures, not the only one. You could perform other analytical procedures. Now let's take a look at this multiple choice question from farhatlectures.com. The most important balance-related audit objective for depreciation expense is accuracy. Yes, you want to make sure depreciation is computed properly. Which of the following is not performed by the auditor when verifying the accuracy of the depreciation? This is not. So we have 3 yes and 1 is not. So if it's 3 yes, try to eliminate them. Okay. Examining whether the client's calculation are correct. Do we have to do that? Of course we have to do that. We have to perform that. So A is out. So now we're down to 2 correct and 1 incorrect. Determining whether a consistent depreciation policy is followed from period to period. Do you have to determine this? Yes, you have to determine this, because it's not about accuracy here. It's also about disclosure. You want to make sure you disclose this if it's inconsistent. Therefore, we have to do this. So this is out. We have to do this. Now we're between C and D. One of them is not. Comparing information obtained through audit test of the depreciation expense account to information disclosed in the notes. So you compare the information through the audit test. So you did the computation and you want to make sure you compare it to what's disclosed in the notes. Do you have to do that for accuracy? No. Do you have to do that? Do you have to undertake the step? Yes. Do you have to do this for accuracy? And the answer is no. Be careful what you are being asked. Now this C is basically deals with disclosure. You have to do this for disclosure purposes, that you have it in the financial statements properly, you computed it properly, and in the disclosure the number is correct. So if you're claiming you have 100,000 of depreciation expense, in the disclosure in the notes you have 100,000, but that's disclosure. Let's look at D. Determining whether the useful life assigned to a newly acquired asset are reasonable. Do you have to do that? Absolutely yes, you have to do that. You have to check the reasonableness of the company estimate. You have to check that. You have to check that. So that's what you have to do. And what don't you have to do for accuracy is C. You have to do it for disclosure. All right. What should you do now? As you see from this question, all the answers are correct. In what sense they're correct? They address something, but if you did not catch that it's accuracy, okay, you would have missed the answer choice. So auditing is analytics. Auditing, you have to be very careful. One word could change everything. And here there are like two keywords: not performed, and you are looking at the depreciation expense accuracy. What should you do to practice more? farhatlectures.com, where I have hundreds, if not thousands, of questions, including AI CPA previously released questions. Whether you are a student or a CPA exam candidate, invest in yourself. Good luck, and of course, stay safe.